Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Well, we hope it is your source. Welcome to the show. The show today is brought to you by CommercialAgentSuccess.com. Check it out if you're a commercial real estate broker. It is awesome training. If you have sales meetings or team meetings, you want to check these out. Brokers really rave about them, and you can check out previews of them at the website, which is CommercialAgentSuccess.com. Well, let's get into the show. You know, when you're investing in real estate, when you own real estate, you're always trying to make the right decisions. And today we're going to talk about economic, demographic, and cultural trends and how that might impact what you're deciding to do. Are you deciding to buy, sell, finance, renovate, develop, or you're helping clients that do that? What about property type? What geographic areas? What size deals? Something that we all want to think about. Well, please welcome my guest. It's Phil McAlister, and he is head of research with Inland. Phil, good to see you. Thanks for joining us.
Hey, Michael, happy to be here. Thanks for having me.
Well, thank you. And first of all, let's talk about the economy. I mean, everybody is really kind of leaning in on it right now with what's going on around the world and with our new president and all of his policies. Everybody's kind of watching inflation and interest rates. Kind of what's the bigger things we should think about right now in the economy, Phil?
Yeah, it's a great question. And, you got to kind of separate it into two buckets, right? What's happening over the short term, the next couple of quarters. And then, when we're thinking about real estate investments, kind of longer term over the next 5 or 10 years, kind of what are the big trends that we're seeing? Shorter term, you kind of mentioned new administration coming in. I think there's a lot of sort of cross currents going on between tariffs and, potential immigration changes and potential tax cuts and regulatory changes. So definitely something to keep an eye on there. I think, on the positive side, some lower regulations, potential tax cuts coming down the pike are certainly going to potentially put some more money into people's pockets, make it a little bit easier to do business. On the potential negative side, things like tariffs. I saw a stat recently, somewhere around 95% of economists agree that tariffs are bad for the economy. Now, to what extent do those get pushed off? How high do the tariffs go? When do they get removed? It seems like maybe this administration is really using those more as a negotiating tool with some of our potential trading partners. So more to come there in terms of what will actually happen. But shorter term, I think we still got to wait and see how some of this stuff shakes out. But the economy's been quite resilient up to this point. Labor market looks like it's still pretty strong. Some of the leading indicators maybe a little bit wobbly, but I'm not overly concerned about a recession or anything at this point. But definitely worth watching as we look at some of those leading indicators. And then longer term, I think there are some interesting dynamics that are going to really impact the real estate market that maybe we get into a little bit later.
Yeah. And Phil, you mentioned that 95% of economists think tariffs are kind of bad for the economy. Is that more, and you're talking about the difference, and we need to look at short term and then long term in commercial real estate, right? We're not typically flipping out of these quickly. Are tariffs potentially bad short term and maybe long term good for the U.S., good for jobs, good for the safety of the U.S., or the 95% tariffs are bad? Is that forever?
That probably is a longer term, concept there. And the idea behind that is really just that tariffs effectively make things more expensive, right? So they will benefit certain industries within the economy and certain, groups of labor, right? If you're an industry that is being sort of protected by these tariffs, you would certainly benefit. But longer term, when you make things more expensive in general, it means that people have less money to go around for other things. So, I don't think it's the end of the world. It's not like it's going to cause a massive recession. But when we did have big tariff hikes, in the early 1930s, the Smoot-Hawley tariffs, it really kind of caused a second crash within the Depression, and that type of argument is really what these economists are making when you think about, all right, well, if we're slapping extra costs onto all these imported goods, that means that we've either got to pay more for them domestically, or we pay the tariff and still pay more for them, as an import. So it does tend to have a negative impact. That being said, there's still plenty of options to kind of drive costs down. So I don't think it's a catastrophic move or anything like that. But over the long term, purely from an economic standpoint, tariffs tend to be more harmful. That being said, there could be negotiating reasons for it, cultural reasons for it, safety, national defense type of reasons for it that we're not really touching on today. So
Right. Good point. And you mentioned the labor market, Phil. So what do you think about the jobs and unemployment today, and what might happen, in the short term?
yeah, shorter term, we do have some leading indicators that are slightly weak. You look at new orders from the manufacturing index for ISM. You can look at sort of what's going on in the yield curve. When the 210, everybody likes to talk about the yield curve inversion that took place a while back for the twos and the tens. When that starts to actually disinvert, tends to be when a recession might start creeping up on you. And then we've also got, the unemployment rate, has gone up a little bit from sort of the mid threes up into the fours. So certain things like that are something to watch, I think. But overall, you're still seeing, jobs created every month for the most part. You're seeing some good resiliency in sort of the income growth side of things. So I think we're doing okay for now, but definitely something to watch over the shorter term. And then longer term, I think we've got just demographic issues that are going to put a little bit of a lid on the ability to grow employment going forward.
Yeah. And at Inland, you guys own a lot of large commercial properties of all types, really, really all over the country. And when you look at the labor market and you look at the demographic side of that, what advice you have for us there?
Yeah, that's where we really try to take a look at longer term. What are the big tailwinds? What are the big kind of demographic trends that we're looking at, and what's going to make sense? And that's where you really got to look at two main drivers of GDP growth, and that is employment growth and productivity growth, right? Sometimes these fancy economists like to complicate it, and there's a lot of moving parts to that. But when you really break it down to its simplest form, right? How do you grow an economy? How do you make more goods and services? You either have to have more people doing the making, right? Increasing employment, or you have to make your existing base of workers more productive. One of those two things, or both of them in combination, are going to be what grows your GDP over time, your real GDP, right? So when you look at what we've got going on right now, we have an aging demographic, right? You have the baby boomers leaving the labor force. Millennials are already in, which is the biggest demographic cohort. Behind the millennials, it's a lower population, right? So from a domestic perspective, before you talk about immigration, we already kind of are a little bit behind the eight ball in terms of being able to grow the number of people that are being employed, which means that a bigger share of GDP growth is going to have to come from productivity. And on that, labor force side, there are various projections out there, but if you take the BLS's labor force projection, I think they're saying that around 173 million people will be in the labor force by 2033. And so you can kind of do a little math there, and depending on what the unemployment rate is at the time, that means that employment growth is going to be somewhere from 0 to, call it 0.5% on a very sort of rosy projection over those next 8 years annually on average. And that compares to about, call it 1.3% in the post-World War II period. So right off the bat, you can see that, we're going to grow at some fraction of where we have historically on the employment side.
That's not too rosy, is it?
Not too rosy in the long term, but again, we're not talking about doom and gloom and recessions. It's just a fact of where the demographics are, right? So maybe we plug that gap a little bit on immigration. Maybe there are some, maybe a big new baby boom hits, and then at least 15, 20 years from now we can kind of get that back. But over the next 8 to 10 years, it really looks like, at least from a domestic growth standpoint, we're going to be a little bit slower. So that then impacts, the type of real estate that might do better, and kind of where we want to put our investment dollars. And on the productivity side, I mean, the big possible green shoot there is this whole AI thing, right? Making workers more productive by allowing AI to kind of take some of the more menial tasks off of people's plates and things like that. We'll see how that plays out. I mean, we had, historically speaking, we've seen productivity trending down as well over the past several decades. That's kind of driven by reduction in kind of domestic investment relative to the size of the economy. As we're shifting to more service-oriented businesses and getting less investment, you need sort of the investment in machinery, equipment, plants, software, those kind of things, training to get more productivity. So that, coupled with a lot more debt, when the national debt to GDP ratio gets above 90%, a lot of good studies out there show that can kind of start to hamper GDP growth as well. So all that kind of comes together to say that our longer term outlook for real GDP growth is just a little tepid, right? I mean, again, not doom and gloom, but if we're used to seeing 2.5, 3.5% real GDP growth, I think it'll be more like 1.5 over the next handful of years or so. So that then kind of informs what we want to do on the real estate side.
Phil, are there regions of the U.S. or states that you think will have better growth than others?
Yeah, and I think that that's really kind of more of the same as what we've been seeing in the past, decade or so. I think the winners are going to keep on winning, right? Driven by uh, cost of living, weather, ease of doing business. All those things are going to keep happening, and you're going to keep seeing more and more, population moving to the southeast. And because of the fact that we're going to have a little bit less, natural organic growth, that domestic migration between states is going to start to matter even more. So, states like Tennessee, Georgia, North Carolina, South Carolina, those states are really interesting to us. And then, Florida and Texas have been, growing like crazy. And those two states also have the benefit of a lot of international migration as well, over and above some of the others. So we do see those types of markets continuing to get the lion's share of the growth. Now, obviously, you got to balance that against the supply side of the equation, where we've seen some of those MSAs get hit with those big waves of supply, in the multifamily sectors and some others. So those have actually been some of the weaker performers on the rent growth side temporarily. But again, taking that long-term lens, I think that's going to be where you're going to find a lot of success.
And Phil, when you guys take that institutional look at where to invest in commercial real estate, as far as sector and timing and geographically, how do you look at supply and where it is today? It seems like with inflation and interest rates that there is beginning to be less supply, and I would expect, tell me what you think, maybe there's going to be less new supply for a few years. Do you take that into account, and what should we think about that?
Yeah, absolutely. I think that's a big piece of the equation, obviously. And, 2021, 2022, interest rates near zero. Everybody and their brother was able to build whatever they wanted to build, right? So you had this big supply wave come, in almost every sector. A few of them didn't quite get it, office and senior housing that were more directly impacted by kind of what was going on back then. But you had this big wave, which is now kind of working its way through the system, right? Mm-hmm. And now when you think about certain sectors that we really like, that benefit from those demand drivers that maybe are not economically sensitive, but are more based on where somebody is in their life, right? If you have baby boomers that are looking to downsize, looking to maybe travel the world, retire, potentially need living options that are going to cater to their health needs, that means something very different than people that are starting a family and growing and purchasing retail goods and those sorts of things. So when you step back and kind of look at how that's that longer term demand really just, you can identify kind of what's moving up and to the right on a steady basis on the demand side. And then the supply is going to kind of oscillate up and down between that. So what we're seeing now with the supply boom is starting to reverse, right? So construction starts have really fallen off a cliff, particularly in multifamily and some of the other sectors. So now that happens, you need a good year and a half to absorb everything that's coming online. And once that happens, right now you're going to be undersupplied relative to that demand in some of these good markets. And then I think we're going to see a handful of really good years from the fundamental side because of that. So, if you're picking the right markets and you're able to be a long-term investor, right now might be a really nice time to kind of get in at a level where maybe valuation is a little bit depressed. And then that sort of, supply demand picture will start to improve over the next several years.
Yeah. So you think about that then, and you're looking at projections. So might you look at, say, an apartment complex and say, hey, we'll probably have flat rents for a couple of years, but then we might see some real jumps in the income, and then therefore maybe you compete for that a little harder?
Yeah, I think that's a good way to think about it. There's certain markets where you feel really great about that long-term demand, but right now because of that higher supply, because of the little bit higher interest rates, because there have been some losses in some of these properties, you can come in at a point where I'm not going to say we're calling a bottom necessarily, but you come at a point where valuations are a little bit more attractive, and maybe for the next year or two you're not able to push rents like you maybe were able to in the past. But coming out of that, then you're sort of in a much better basis, and then you're able to enjoy that growth over time. So that's kind of where that long-term investment mindset, longer-term horizon, I think makes a lot of sense, particularly if you're not going to over leverage, not going to try to get too much juice out of the deal, but you're really just looking for those solid kind of fundamentals.
Yeah. And assuming inland, you guys like multifamily and industrial, is that right? And there are other sectors that kind of interest you right now?
Yeah, I think the sectors that really interest us the most right now are actually some of the what you would call the alternative sectors. So self storage, we really like right now. That sector had gone through a bit of a downturn, really kind of as a reversion of a very strong performance. Mid teens kind of rent growth for a couple of years there has kind of come down a little bit, and there may be some opportunities in self storage. Senior housing is one that we really like a lot. Medical outpatient buildings, some student housing, I think, can be very interesting, and then multifamily will always be a big part of what we do. And sort of the common theme that runs through those sectors really is that these are the demand for those sectors is driven by demographics, not necessarily strong economics, right? So you can do well in those sectors because of where people are in their lives, right? When you start a household, you need self storage. When you're growing into a larger household and affordability becomes an issue and you can't own something, something like a BTR type rental makes a ton of sense for you. So those are the areas that we're trying to target, that we're saying, hey, even against a backdrop where economic growth might be a little slower than usual, these things should still have really solid demand going forward, and we really like the fundamentals.
On senior housing, do you guys team with operators? Are there?
Yeah, that's typically Inland's MO, right?
Or
Is
do you
to
operate
find
the
good
senior housing?
operators in the markets that we're in and team up with them. Yep. Yep.
Yeah. Okay. One of the challenges that maybe all of our listeners are dealing with now is insurance cost. What have you guys done there to try to mitigate some of those cost increases?
Yeah, it's been tough. I mean, obviously, depending on the market, you've been hit with some pretty tough increases across the board. There are some ways to potentially mitigate it. There's, obviously having a good amount of scale, being able to kind of be a good buyer in the market can help to get costs down. And then just looking at, we have an entire insurance and risk group here that's constantly working on how do we tweak the coverage and everything to make sure that we're getting the best possible rates. But it's been a grind, and that does impact what markets that we want to look at, and kind of thinking about how the future is going to look. But I think we've seen the worst of those insurance increases now, and I think that's starting to at least level out a little bit more, and we got a little bit more visibility into kind of what the increases will be in future years. But yeah, it's definitely been something top of mind around here.
Yeah. Well, Phil, I'd like to get your thoughts about inflation and what you expect moving forward, and kind of how you guys look at it at Inland, because in some ways inflation, think about replacement costs today. I'm selling some beautiful office buildings at about 25% of replacement costs, and it almost seems like it's going to be hard not to win at long term with those kinds of deals. But of course, inflation has a lot of negative issues for the economy and for commercial real estate. What should we think about inflation today?
Yeah, it's a great question, and I might make myself a little bit of a pariah on this one because I'm a disinflation guy. I think that's kind of what's likely to be happening going forward, and it kind of all ties back in a little bit to what we've been talking about, right? So when you've got aging economies and slow growth economies, they tend not to produce a lot of inflation. You can look at Japan, you can look at the European Union, who are ahead of us in terms of the aging trend and the population, the slowing of the population growth. Both of those countries have a ton of debt, very active central banks, and outside of a minor blip during the pandemic era, they just have not been able to create really much inflation at all. And I think that's kind of the backdrop that we're in as well, right? We don't have this robust younger class of people that are coming in and buying up consumer goods at a rapid pace. And globally, there's a ton of capacity out there to manufacture and to create goods and services for people. So I don't see there being a lot of pressure on prices going forward. I do think that the word that had been thrown around and made fun of early on in the inflation cycle, that this would be transitory, I think it actually was. It just took a little bit longer to play out than some people were hoping for. But if you actually look at a chart of CPI growth, particularly you pull the shelter component out of CPI because it's a very lagging component of CPI, or if you replace that with actual rent growth, which fell off a lot quicker, what you see is that inflation was actually understated. It was worse than we thought it was in 2021, 2022 because that shelter component wasn't going up fast enough, and now it's kind of propping inflation up higher than it should be. So CPI excluding shelter dropped below 2%, almost 2 years ago now, toward the middle of 2023. And it's really stayed under 2% or kind of bounced around 2% ever since then. So I think that now that we've sort of gotten that big stimulus QE pandemic thing behind us, we're going to see inflation look a lot more like it did, 2009 through 2019, where, tepid growth, low inflation, and that also kind of comes with some lower interest rates on the 10-year Treasury as well, which I think will be pretty impactful.
Yeah, well, let's talk about that. I mean, interest rates are exciting to our audience. What do you expect moving forward?
Yeah, on the interest rate side, depending on what kind of real estate you're involved in, if you're doing construction or short-term renovations, you're probably more worried about the SOFR rate, which is the short end of the curve and much more directly controlled by the Fed, right? So that is a little bit tougher to predict because you're trying to figure out what a political animal is going to do, right? But on the 10-year Treasury side, for longer-term investors, if you were to look at a chart of nominal GDP growth relative to the 10-year Treasury, if you take the last 10 years or the last 40 quarters of nominal GDP growth, and then you plot that against, that average growth against the 10-year Treasury at the time, what you'll see is there's a really nice correlation there, right around 87% correlation factor, which means that a big part of, the 10-year Treasury's moves are going to be related to what's going on with growth and inflation, right? Mm-hmm. So if I'm directionally correct about where growth and inflation are heading, that means we're going to kind of have a soft nominal GDP growth environment. And, you're probably going to be within 50 or 100 basis points of that long-term average for nominal GDP over time. Right now, shorter term, if there's a flight to safety or if there's a fear of another inflation spike or a big, fiscal stimulus happens, you can certainly get moves in the 10-year Treasury, up or down. But generally speaking, right now we're hovering right around 5% for a long-term sort of 10-year average nominal GDP growth. And that's typically correlated with the 10-year Treasury rate that's, below 5, somewhere in 3.5% to 5% range. So if inflation kind of keeps tracking downward, like I think it has a good chance of doing, and we get those sort of a little bit more modest real GDP growth rates, that tells me that, it's certainly not a guarantee, but the likelihood of lower rates over time probably outweighs another big spike. And, somewhere in that 4.5%, 5% range might be pretty close to what the higher range of what the economy can produce based on what we're seeing.
Yeah. And Phil, what do you think about the timing for acquisitions right now? I mean, you talked about maybe less new supply. Maybe you get in at a little better basis because money's not free right now. It's back to more historic normal rates. A good time to buy if you're in the right asset?
I think it is. And I think it depends on your strategy, your balance sheet, your investment horizon. A lot of those kind of things come into play here, right? Because if you're trying to get in and out of something very quickly, you need to see that lift in rent growth right away. So you either got to create that by doing a great renovation or something, or you've got to kind of ride the coattails of the market. So that kind of thing might not be, as well, well received right now. However, if you're looking at long-term investments, right, you want to take long-term debt out. You want to, create value over the longer term. I think this could be a really interesting time to buy, particularly in some of those sectors, again, that have those demographic demand drivers that'll kind of keep pushing forward. And, if you look at, the NCREIF index, for example, the Odyssey index is sort of core real estate assets in these open-ended funds. That index came down about 18% over the last few years, and it looks like it's sort of starting to bottom out there. We had a positive quarter at the end of 2024 there, and we'll see what happens here in the first quarter of 2025. But that index has only pulled back really 3 times since it was created. It pulled back in the savings and loan crisis, pulled back in the great financial crisis, and it pulled back here over the last couple of years. So that's obviously never a guarantee that it's going to happen again or that we're going to do better again. But the past 2 experiences have proven to be pretty solid buying opportunities, right? And for a lot of the reasons we're talking about, you get a little bit better pricing. You maybe ride out a shorter term of kind of getting through some of this new supply. And then kind of going forward, you're in a better position to get a better valuation on those assets for the long-term hold. So that's kind of the way that I see the world.
Yeah, well, it makes sense. And we talked about making decisions on commercial real estate through economic, demographic, and cultural trends. Talk to us about cultural trends. What should we think about there?
Yeah, I mean, obviously that's that's anybody's guess to a certain extent what's going to happen with how people feel, culturally. But what we're seeing here, I focus on sort of the millennial generation culturally. Maybe it's just because the one that I understand the best. But what you're seeing there are people that are, at first the question was, hey, are these millennials ever going to really want to settle down and have families, or are they going to ever want to own homes because they saw what happened to their parents in the great financial crisis, right? And those sort of cultural impacts have certainly had some impact on the choices they've made going forward. But now we are seeing that even though they don't appear to be having kids at a fast clip at this point, they are starting to look to own homes to settle into sort of a new household formation type of pattern. And that brings with it certain aspects of the real estate market as well. So you think about the BTR subsegment of multifamily, I think looks really good in that lens, right? As these millennials who really would love to own a home, but maybe they don't have the credit score for it, maybe they don't have the savings for it, maybe that affordability is just too tight for them. Whereas 10, 15 years ago, maybe they wanted to be in the city, smaller apartment, more close to the action. Now a lot of those groups may be looking for sharing less walls, sharing less sounds and smells, and being on top of each other in the way that they used to. And they want to have a little space. They want to have a little yard. They want to be able to have a dog and maybe have a kid, maybe have an office for work from home. So those type of cultural changes are something that we keep an eye on, and how that might impact things, on the real estate front. On the other side of that, how people are going to start treating retirement and new living arrangements on the boomer side, also really interesting as well, right? I mean, a drastic shortage of senior housing units is going to be out there if the penetration rate, or if the same amount of people 75 to 80 years old continues to want to use senior housing in the future. So how those people react to that, is there going to be more at-home care? Are there going to be more, different projects that are developed to cater to those needs, is something to really keep an eye on as well. But I think it creates some really interesting opportunities for real estate investors that are kind of on top of these trends.
Yeah, I agree. We have a senior housing division, and it was kind of, I don't want to use the word dead, but I will. It was dead for a few years, right, during COVID and all that. And then it's just kind of exploded more recently with a lot of interest from buyers. And then a lot of sellers are kind of ready. They've had a hard time for a while. They're like, okay, I'm ready to sell. So you like senior, you like medical office. Talk to us about the cultural trends there. And then I guess it's more demographic, right?
Yeah, it's probably more demographic, and it goes hand in hand with senior. But when you look at the stats, as people get into their 70s, the amount of money that they spend on healthcare services just really skyrockets. It goes through the roof. And at the same time, what we're seeing as a trend in the healthcare space is that more and more services are being delivered in an outpatient setting, whereas you used to have to go to a hospital for a lot of these things. A lot of the surgeries and procedures and things like that are now being delivered on an outpatient basis. So you've got this interesting dynamic where it costs a lot of money to build these things, and it's really hard to kind of keep up with the demand on the supply side. And at the same time, you're just having more and more services wanting to be delivered outside of the hospital, and you're going to have more and more of those services demanded just as people naturally get older. So a really interesting space to be able to, find a way to benefit from that outsized rent growth. And if you look at the last, handful of years, you've had absorption well outpacing completions in the medical outpatient building space. And, when I look at, the available sites, the cost of land, the cost of construction, it's really hard for me to envision a scenario where that supply really starts to overwhelm the demand. Now, it certainly could happen if new ideas come out that allow better development, faster development. But right now, it seems like that's going to be a pretty chronic shortage in both the medical outpatient and the senior space, just on that long-term supply-demand dynamic. So you find the right markets, find the right tenants, on the medical and on the office side of things. In the same way that traditional office, medical outpatient is the same. You got to really understand the credit. You got to really understand, who you're renting to and what their plans are, and if they're going to be sticky. But you get through those things, and that's going to be a really solid sector, I think, going forward.
Yeah, that's a good point. Paul Zeman leads our medical office group here, and he was asked the other day, what's the difference between office and medical office? And he said, well, they're exactly the same, except medical is just a lot more involved. It's a lot, a lot more difficult, a lot more moving parts, a lot more things going on. All right, well, Phil, thank you for joining us. We appreciate the intel. Thanks for being on the show.
Yeah, this has been great. Thanks a lot, Michael.
All right, thank you. And thank you for joining us around the country. Check out Inland Private Capital Corporation. Inland is a great company, a lot of great people there. And hey, let us know if you need anything around the country, if you need a source for a lawyer, you need a developer, you need a lender, you need a broker, anything you need, let me know. We'll try to find you the right person. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at CREshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.